Good day, fellow investors. One of the worst performers over the last year have been REITs. And Andre here sent me an email because I asked for some testimonials for my research platform. And in return for that, I said I'll answer one of your questions. And he asked about REITs, and therefore I said, okay, I haven't done a REIT video in a while, and why not go into the REIT situation for 2022? 2023 now, yeah? Yes, Sven, 2023. Let's start. I want to discuss the general factors for investing in a REIT, what impacts the thing there, a touch on REIT management incentives, medical properties trust stock that has been battered down, Vonovia stock, and then conclude with something that should likely help you whenever you consider or you actually invest in REITs. I haven't discussed REITs for 2 years now, which is a long period of time, but there has been a reason, and that reason is, as I said in that last video, interest rates. This was a specific revaluation issue for a European analysis, but let's dig deeper into REITs, interest rates, and the situation there. If we look at the Vanguard Real Estate REIT Index Fund, you can see that over the last years, it was at 85 years ago, it did 8%, okay, plus some dividends, but it's not spectacular considering the market, I think, did much more over that period of time. And things especially started deteriorating here when interest rates went up. The first factor, therefore, is leverage. That's the name of the game when it comes to REITs. You buy something, 40% equity usually, 60% of the remaining money is leverage. And it was interesting, Medical Property Trust investor update, last one presentation from August 2022, leverage is not even mentioned in the presentation. But if I look at things, it is pretty significant. So total liability is $11 billion and the share of equity went from 46% to 43%. So they have been growing by increasing leverage and also by increasing the number of shares from 0.2 million or billion to 0.6. The issue with leverage is that when interest rates are low, it's okay, and when there's plenty of liquidity. But if interest rates change, there is a debt cost that increases, and many of you have been getting some mails. Sven, I cannot invest anymore because my variable mortgage is going up and I have to put all my money there. That's unfortunate. That's why I always told you to take fixed mortgages. But here we are now, and with 10 billion in long-term debt, that's a huge difference for such companies because 10 billion at 4% or 8%, there is a 400 million difference yearly. And cash from operations are now this with still low interest rates. So you can halve the cash income if interest rates go up. And that's exactly what hit the stock hard because with interest rates higher, 400 million cost on a market cap of 5 billion, 10 billion is huge. And they say they will keep the dividend. They might not. The next factor is asset values. With higher interest rates, it's not just more interest cost, and you will here get a hack about investing in REITs that few ever mention. It's not just about the interest cost, it's also about the debt compared to the asset value and what the debt owners want. So we have here total real estate assets 11.5 billion. Remember the debt of 11 billion. And this is very important because with, let's say, this is the high yield. I take it might not be a representative of the yield for REITs, but it's a good indication of how yields move. Of course, if you can borrow at 4% or you have to borrow now at 8%, that's a huge difference when it comes to valuation too. This is Boston Property and another commercial REIT, and let's say they own this building that makes 5 million in rents per year. If you're happy with the 5% return, the value of that building is 100 million and you pay happily 100 million. If you need an 8% return from that building, and I'm sure you cannot increase rents from 5 million to 8 million in a year, then the value of that building is just 62 million. And that's huge, and that has a huge impact on businesses. And you already see here medical properties, a write-down of 250 million, which is a big chunk of money. But despite the write-down, the management has taken its 50 million in stock-based compensation. We'll talk about incentives in a moment. Now, I'm looking at this and I'm looking at, okay guys, you take more debt, you issue a lot of shares, reach for paid capital and everything, but do you really add value, or you just increase the business so that your stock-based compensation goes up? That's the issue with REITs. They do their job. They are hired, but for what? They are hired just to manage a building. You don't need a REIT, you don't need a stock, you don't need anything for that. If you own a building, you have your manager, you get the money, you don't care about the ups and downs, the growth. When you have more money, you might buy another building and that's it. But REITs, if you look just at the numbers here, they are growth levered machines and also equity issuing machines. And if you look at medical properties trust, the stock now is lower than it was 10 years ago, than it was 15 years ago. So all the mumbo jumbo the management didn't actually create value for anybody except for the management. The number of shares went from 2 to 6 million, billion, whatever. The cash from operations, yes, it went up, but now with interest rates higher, it's always nice to borrow at 3% and then invest in a building at 5%. But if this becomes 6%, you lose your shirt, and free funds from operations, in this case, really good, high, but nothing spectacular. So especially when you know it is levered, and if these buildings lose value because of higher interest rates, because of issues with hospitals or whatever, then this becomes an issue, and these loans at 2% will get refinanced. You need to get them refinanced, and here is something that many forget when it comes to investing in REITs. It's not about, okay, will they refinance? It is about the owners of these notes that are due soon, looking at the properties and saying, is this property worth 100 million now? If it's worth 62, I'm not lending them to refinance this. And they simply say, no, I will not give you the money. If you cannot get the money to refinance this, you go bankrupt, so like some banks recently, and you as a shareholder cannot do anything about it. That's the hack that happens. Same principle holds for Vonovia, European German residential REIT. The stock has been hammered, and I've been receiving many questions here because of the beautiful business model, but it was all leverage, and people were just focused on the growth, and they were happy to pay, what is this, 60 euros just a while ago for this share, and now it is at 20. And then you think, Sven, yes, but the business is there, the rents are collected, everything is great, the dividend is 8%, it should be a buy. Okay, it's a completely different story now. The dividend per share, they expect it to be 1.7, so very good return here, 8% on the stock price. They have been increasing it constantly, but I did some researching, going into the conference call, and here is Rolf, Lieber Rolf. He discusses the business, but it's very interesting. I realize that interest of many for you lies elsewhere at this point than the business. And then he highlights how he thinks the sector will not experience any large loss in valuation and that has peaked and moved sideways. Of course, he is paid to say that. He is paid to keep guidance stable, and guidance is stable with the cash flows and everything, so likely they will be able to pay the dividend. But here is the issue. House prices have skyrocketed in Germany, and the question is, what happens to Vonovia if house prices return to levels of a few years ago? They say prices haven't fallen for 50 years, no weakness in 50 years. Well, no weakness, because for 50 years interest rates have been going nothing but down. If the environment changes, it might also change for Vonovia. And here we have Rolf. He is now, what is this, 65, he is now 58 years old. He is paid good money. He can make up to 7.7 million, and he is paid to grow the company. You wanted this. If you're a Vonovia shareholder, you paid him, you hired him here to take leverage, to grow the company, to grow the dividend, because that was the name on the game. So don't put this on Rolf. He's just doing his job, and he will continue to do his job by saying that there will be no weakness. That's what he is paid to do. But the long-term debt there is 42 billion, and the total assets there are assets based on what they have paid for those assets. And there is 40 billion of debt here that expires sooner or later, but the 40 billion means only one thing. 68 billion of total liabilities, yes, 68 billion of total liabilities with the debt means only one thing, that the company is owned by debt holders, not shareholders. That's the risk there. If the debt holders say, nah, this isn't for us anymore, we need higher interest rates, you can think, yes, but we are still collecting rents for everything. They don't care. They will start collecting rents from tenants in your name. You as a shareholder, yes, that is the risk, and that explains the stock prices. Plus, they paid 19 billion to acquire Deutsche Wohnen, and their market cap is now lower than this. They made a high offer per share 2021 when Rolf felt powerful and strong, but they bought at the peak. And the next key factor now is, as I said, it's not about the dividends. It is about what they will do with Vonovia, what they decide, whether they will be at the mercy or not, which then depends on the market environment. Next key factor to think about is how the environment changes. So, SVB Bank, proud to be on Forbes annual ranking of America's best banks for the 5th year in the row. But these analysts, and Rolf is not paid to think about how the environment changes. Rolf has been paid to borrow at 3%, invest at 4%. The spread, the 1%, makes money. The problem is that when the environment changes, and it usually changes every 15 years, 10, 15 years, all these business models that take advantage of those spreads are, and that's REIT investing. So you have to be really, really careful about that, because over the last 40 years, we have seen increased liquidity, lower and lower interest rates, and for the first time now, interest rates are higher than the previous peak. It was just lower, 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 and now, oops, inflation, and we see things higher. And even now, with the bank issues, immediately the Fed reacts, which leads to more and more inflation. And then you think, yes, Sven, but REITs, real estate, we have protection. No, the bondholders own the REITs. If you own a building in Berlin, yes, that's you get your free cash flow from the tenants, and that's it. With leverage, you are at the mercy of bondholders, and when systemic risks happen, bondholders try to protect their behinds, not your behind. That's investing. And this is Swiss franc against the dollar with inflation, with printing. You can see the trend here, slow and steady, eating up the value of the currency. At some point, the Fed will not be able to just print liquidity without spiking inflation. That won't be a disaster for those who invest well, who are prepared for investing even if the environment changes. But if you're invested in levered bets, then I. So I don't know what will happen to Vonovia. I hope that it will manage to refinance everything, keep the dividend, and if interest rates go lower, the stock will be 40 in 2-3 years. If not, it can continue to just be ugly. So it is still a levered bet, high upside. The risk is you lose everything. So from a risk and reward perspective, it might be okay, but you have to see how that risk and reward fits you. Don't buy it, I'm buying a safe dividend. You are not. You are buying something at the mercy of bondholders, which might be an interesting risk and reward bet. That's it. I'm sorry for this negative take on REITs, but if I need to invest in real estate, I would prefer to do it myself, where I have the control over the leverage, over the everything, when I can shift money, where I can be both the bondholder and the owner, and then that's real estate investing. This is risky, especially if the environment changes. And REITs have been the greatest performers because interest rates went down. Sorry for that. I'll be looking for other businesses. Check my research platform if you're interested in different businesses. I'll see you in the next video.